Over 20 years ago, my partner Ken Levy and I established the Bernstein-Farbozzi-Jacobs-Levy Awards to honor journal portfolio management editors Peter Bernstein and Frank Farbozzi, and to promote research excellence in the theory and practice of portfolio management. We're proud to say that over 85 articles have received awards over the last 21 years, and they have all lived up to a very high standard. The Journal of Portfolio Management, just this past year, created an event to celebrate the 20th anniversary of the Bernstein-Farbozzi-Jacobs-Levy Awards, and we're pleased that many of the award-winning authors attended. Every 5 years, we compile a volume of the award-winning articles, and we include commentaries from the award-winning authors, and also an introduction that's written by Frank Farbozzi, Ken Levy, and myself. We have just completed the 4th volume. We're very much looking forward to the winning authors in the years ahead. We all know that for many years, there was a strong belief in the efficient market hypothesis in the halls of academia. However, by the late 1980s, it had become apparent that there were chinks in the armor of the efficient market hypothesis. There were opportunities for outperformance associated with small cap stocks, companies experiencing positive earnings surprises, and companies having low price to earnings ratios. These were referred to as anomalies. Today we call them factors. It was important to examine all the known factors jointly. That was something no one had ever done before. It was my idea and Ken Levy's to examine all the factors in a single unified framework. That way we could determine which factors really matter, which is so critical for investment management. In 1988, we published our article, Disentangling Equity Return Regularities, New Insights and Investment Opportunities, which examined 25 factors jointly for a 25-factor model. 4 years later, Fama and French published their 3-factor model. Subsequent to our disentangling article, we wrote an article in the Journal Portfolio Management called The Complexity of the Stock Market. We found that some factors are persistent and others are cyclical and potentially can be forecasted. A few important questions arise in how to use factors in portfolio management. Should you use one factor, a few, or many? Should you use a constant exposure to a factor which is maintained? Or instead a dynamic exposure which varies with the business cycle? Should you use well-known factor definitions, or should you use proprietary ones? We have published several articles on this topic, including Smart Beta versus Smart Alpha in the Journal of Portfolio Management. Short positions can expand the opportunities by anticipating which stocks will decline. The question, however, is how best to include short positions in a portfolio. It's not as simple as taking a short portfolio and adding it to a long portfolio. That would not capture the full benefits of shorting. We proposed an integrated approach where the shorts hedge the longs and vice versa. We wrote about this in a Journal Portfolio Management article called Long-Short Portfolio Management, an Integrated Approach. Long-short portfolios are often constructed to be market neutral, with a balance of long and short positions. Then it's an absolute return strategy measured relative to cash. However, a long-short portfolio can be constructed so that it can be benchmarked relative to an equity index, and then its performance is measured relative to the equity index as well. In our paper on the optimality of long-short strategies, we introduced the idea of a 1-30-30 portfolio. In a 1-30-30 portfolio, for every $100 of capital, $130 is invested long and $30 is invested short. for a net market exposure of $100. This way, you can benefit from winning stocks and losing stocks while maintaining a full market exposure. We describe this in our Journal of Portfolio Management article, Enhanced Active Equity Strategies, Relaxing the Long-Only Constraint in the Pursuit of Active Return. In order to address whether 130-30 is the right amount of leverage in contrast to 120-20 or 150-50, we needed to reinvent modern portfolio theory. Modern portfolio theory considers the expected mean return and variance of return with no consideration of leverage risk. Modern portfolio theory is really only appropriate for long-only portfolios where there are no shorts nor any leveraged longs. To account for the risks of leverage, we added a third dimension to modern portfolio theory. We call it the unique risks of leverage to represent margin call risk, which can force investors to liquidate securities at adverse prices. Our mean variance leverage model considers not only investor aversion to volatility risk, but also investor aversion to leverage risk. It provides a more complete representation of the risks in a long-short portfolio. In mean variance analysis, there is a two-dimensional efficient frontier that shows the trade-off between expected return and variance of return. In mean variance leverage analysis, there is a three-dimensional efficient surface that shows the trade-off between expected return, volatility risk, and leverage risk. We introduced this new model in a series of articles in the Journal of Portfolio Management. Harry Markowitz, the father of modern portfolio theory, in the pages of the Journal of Portfolio Management, agreed with our formulation. We used the mean variance leverage model to show that 130-30 is an appropriate level of leverage for an investor having typical aversions to volatility risk and to leverage risk. Ken Levy, Harry Markowitz, and I developed a novel way to analyze and anticipate market behavior. We developed the Jacobs-Levy-Markowitz Market Simulator, which considers the behavior of investors, security analysts, and traders. Security prices are determined endogenously through the interactions of these different participants in the simulated market. We programmed two types of investors: momentum investors who follow the trend, and value investors who trade against the trend. We found that if there are too many momentum investors, there will be a tendency for bubbles and crashes to occur. This was very much like what happened during the internet bubble in 1999, when prices bubbled up and subsequently crashed. We also found that traders need to anchor their bids and offers to recent prices. Otherwise, there can be crashes, like the flash crash of 2010. We wrote about the simulator in a Journal of Portfolio Management article called Financial Market Simulation. Later, we wrote about the simulator also in another article called Simulating Security Markets in Dynamic and Equilibrium Modes. Anyone who would like to make runs on the Jacobs-Levy-Markowitz Market Simulator can do so through our website. We have made it publicly available. Many of the ideas we're talking about today and the associated articles are in our book, Equity Management, the Art and Science of Modern Quantitative Investing. In the subtitle, we say art and science because art is the insight and the intuition, and science is the use of quantitative methods. Both dimensions are essential and they are complementary. In two other books I've written, Capital Ideas on Market Realities and Too Smart for Own Good, I examine the common causes of financial crises. The instruments and strategies are often complex, meaning they're opaque and they entail substantial leverage. They also have an option-like nature which causes markets to behave in nonlinear ways. These strategies and products are often sold as a free lunch, promising high returns and low risk. With the allure of a free lunch, investors pile into these strategies. They end up looming large in markets, and they can give rise to market bubbles. However, when investors need to exit these crowded strategies all at the same time, they can give rise to market crashes. I'll provide some examples of past crises. Portfolio insurance promised protection against stock market losses while allowing capture of stock market gains. It required forced selling of stocks as prices decline, which caused the 23% crash on October 19, 1987. Long-term capital management was the huge hedge fund with highly leveraged positions, but presumably low-risk arbitrage trades. It became the dominant trader and experienced large losses. Those losses gave rise to margin calls, which forced selling of stock. This contributed to the market turmoil of 1998. The global financial crisis of 2008 was triggered by massive defaults on subprime mortgages. These subprime mortgages were held by securitized products that promised high yield but low credit risk. We all know what happened to the economy and to the markets. Remember, if a strategy or instrument sounds too good to be true, it probably is. My views about the causes of financial crises are also expressed in a journal portfolio management editorial called "What We Still Have to Learn from the Credit Collapse and Other Market Crises."